From world-class Formula One racing events to the famous casinos, Monte Carlo is a city known for glamour, luxury, and all the excesses of wealth. However, there is a little lesser known statistical modeling tool that shares namesake with this famous city. Today we'll be talking to you about the Monte Carlo simulation, an incredibly useful statistical tool, how it works, and most importantly, how we can apply it to real-life situations. In particular, we will see how this tool can be used with publicly available S&P 500 data to explore a very relatable question. What is the likelihood of reaching a desired retirement savings target over a period of 30 years? But to start with, what actually is the Monte Carlo simulation? Well, at its core, it's a statistical technique useful for modeling uncertainty. Now, I know that sounds pretty confusing, and it kind of is, so think of it this way. Rather than forecasting using one average outcome, the Monte Carlo simulation utilizes a process called random sampling to run thousands of trials with randomized inputs. Think of each of these trials as being a unique scenario due to its randomized conditions. By analyzing the distribution of the output of all the different trials, we can see the probability of one certain scenario occurring over another. Ultimately, the Monte Carlo simulation can be distilled into the following 4 steps. Step 1, build a model using historical data or assumed probabilities. Step 2, generate random inputs through the process of random sampling. Step 3, run the simulation with a higher number of trials yielding better results. Step 4, analyze results using statistical summaries with relevant data visualizations. For instance, let's take a look at an example that we could use the Monte Carlo simulation for in the context of its namesake. If we wanted to try and predict the results of a roulette spin, in this case attempting to find what the likelihood of the ball landing on a number in the top third or between 25 and 36 would be, we could employ the Monte Carlo simulation. To perform the simulation, we would simulate thousands of randomized spins, and although a simple prediction would lead us to believe that 12 numbers out of 37 would lead to a 32% probability, the power of the Monte Carlo simulation is that instead of just calculating that trial once, it shows us how the results can fluctuate across many trials, with the probability of the ball landing in the top third potentially changing across the many trials. But how can the Monte Carlo simulation apply beyond the neon lights of its namesake? Well, it finds many real-life applications in the following fields. First, and most relevant to today's video, is its application in finance, the realm of gambling for people who can pronounce tranche, with uses in areas such as risk assessment and optimizing trading strategies. Another would be its uses in engineering and science, where the roots of the modeling method actually lie. The Monte Carlo simulation is a product of the physicists and mathematicians John von Neumann and Stanislaw Ulam, originating all the way from Los Alamos during the Manhattan Project in World War II. These scientists needed a way to solve complex problems related to neutron diffusion and proposed a statistical approach involving random sampling to estimate these outcomes, in doing so giving life to the Monte Carlo simulation, so named for the model's use of chance via randomized numbers. Additionally, this model can find use in the healthcare sector, with a poignant example being in crises such as the recent pandemic, with the simulation having potential uses in estimating the spread of diseases, thereby helping hospitals plan for outbreaks by more efficiently allocating staff and resources. One other increasingly relevant application is in artificial intelligence, and specifically in both training these learning models and subsequently being a tool of these models. Now that we have some idea of how the Monte Carlo simulation can be used in the real world, what is one real world issue facing us currently? Well, one such major problem would be retirement savings. Pervasive to modern society is anxiety related to retirement savings and whether someone will have enough money to sustain themselves post-retirement in their old age while still being able to leave something for their children. This problem is starkly apparent in the poverty rates among elderly people, specifically those over 66 years of age, where in this group there is an alarming 22.6% poverty rate, considerably higher than many other OECD nations. Some seek to tackle this issue through investing in the stock exchange, but what guarantee does someone have that they can make worthwhile profits in the period before their retirement? How can we use the Monte Carlo simulation to approach this problem then? First, we start with a question that we will use the simulation to investigate. In this case, our question will be, with a $10,000 investment into the stock market, could an individual over the span of 30 years make enough of a profit to amass a supplementary retirement target of $300,000? Now let's first examine the parameters of the question. This premise is designed to help individuals in their mid-30s who are considering the path towards retirement. With 65 being the current ideal age for retirement, therefore a 30-year time span was chosen for this simulation. According to data from Westpac, the average 30 to 34-year-old has $21,000 in savings. Therefore, this question seeks to examine what the potential gains would be from investing half of this into the stock market. And finally, 300,000 was chosen as the retirement target, as although this may not be enough to solely retire on, it will be a realistic amount that could comfortably supplement other retirement savings. We can use these parameters in addition to relevant historical stock market return data in order to estimate the probability of reaching the set returns target. For the dataset, we will be using annual S&P 500 historical total returns from the past 30 years. This time frame captures both market peaks and catastrophic market crashes. This variability in returns will hopefully simulate the real-life volatility of the market and allow us to make more realistic and therefore much more useful simulations, able to create thousands of plausible 30-year investment paths. Additionally, in order to further enforce the realism of the simulation, we will attempt to factor inflation into the returns at a rate of 3% per year. To ensure the reliability of our subsequent results, we will run 50,000 trials, allowing for a good spread of results. To transform this dataset into valuable and useful information through the Monte Carlo simulation, we will need to use the appropriate tools. Many different software and programs can be used to craft and run a Monte Carlo simulation, such as Excel, R, and Python. However, to address our investigation question using our set parameters, we will be using Python, as it allows for more flexible and easy to follow process. To allow our Python code to analyze, run, and then visualize our S&P data into a Monte Carlo simulation, we will need to employ the use of three relevant libraries, being NumPy, Pandas, and Matplotlib. Seaborn could have been used if we were to explore more complex visualizations, but let's keep it simple today. The first step will be to load and clean our dataset. Next, we want to calculate how much this index changes monthly, and this will be our returns. Then we will consolidate these monthly returns into yearly returns. Then we assign our previously discussed parameters. Finally, we will create and run our Monte Carlo simulation. The simulate bootstrap function in this code takes in the historical returns and randomly samples 30 years at a time. Repeated 50,000 times, this gives us the final portfolio values for each trial and lets us calculate the probability of hitting our $300,000 target. Following this, we code the relevant statistical summaries, being the mean, median, 90th, and 10th percentiles, along with the chances of our investment reaching the desired target. Using Matplotlib, we perform three key visualizations, the first being a histogram. Next, we will simulate the paths of the investors' portfolios for 30 years for the next two visualizations. Using the paths generated, first we will create a fan chart, and then we will make a time series chart depicting the investment paths over 30 years. After running 50,000 simulations examining our question of, with a $10,000 investment into the stock market, could an individual over the span of 30 years make enough of a profit to amass a supplementary retirement target of $300,000? We have gained many useful insights with a summarization showing the following. The median income was around $94,000. This represents what the standard investor could expect from their investment. The mean outcome was noticeably higher, returning around $134,000. When compared with the median, this value shows that a small amount of large returns shift the average of returns upwards. At the 10th percentile, outcomes were as low as $27,000, showing the risk associated with such an investment, as this amount would be less than what could be earned by leaving the principal in a conventional savings account. At the 90th percentile, wealth exceeded $286,000, showing the potential returns of the investment. And most importantly to our question, from analyzing the outcomes of the trials, we can see that only about 9% of the trial paths ended in a return above $300,000, indicating that the chance for investors to make the targeted amount of money is very low. However, despite the targeted returns not being met, by analyzing the results of the different trials through the following charts, we can gain some very useful insights about this investment plan. Firstly, from this histogram, we can see the distribution of possible investment outcomes, with the majority of the investors' portfolios ending below the mean. while there are a few investors that far exceed the mean, indicating that while extreme success is possible, there is a greater possibility of low returns. This is further evident in the time series chart where we can visually examine the investors' paths. We can see that although many investors' paths can be seen growing far past the set target, far more fall below it. This trend is further evident in our fan chart, where it traces what the standard investor could expect from their portfolio over the course of the 30-year period. So in summary, while hitting the $300,000 target is unlikely, the simulation demonstrates that long-term investment still delivers substantial gains compared to safer, lower return options. However, I can only praise the Monte Carlo simulation so much, as although it is a powerful statistical tool, it, like all models, has both strengths and weaknesses. The main advantage of this model is its ability to use uncertain real-world scenarios to create realistic estimations of probability by capturing a full range of outcomes, allowing for more informed and strategic decision making. While its weaknesses would be its reliance on input data, which can lead to the model being unable to account for unforeseen events. Additionally, a real-world drawback of the Monte Carlo simulation is the computational power required to run the simulation for bigger datasets and more trials. Now to summarize, the Monte Carlo simulation is a powerful tool with a wide range of applications, and most importantly to this video, is especially useful in finance and investment planning. However, it is not perfect in prediction nor efficiency. But by understanding its strengths and weaknesses in equal measure, potential investors could use this tool in planning their futures and retirements with more confidence and surety. Thank you all for listening.